Well, welcome to our next volume of the video instruction. For the topic area of corporate finance, we're going to be talking about corporate governance. The reading titled Corporate Governance and ESG, an Introduction. So corporate governance, what we mean by that is the internal controls and procedures for managing a company, so how it's governed. The older theory for corporate governance is shareholder theory. And under this theory, we're focusing on the interests of the company's shareholders exclusively. And as it's evolved, many subscribe now to the stakeholder theory, which focuses on managing conflicts among the interests of various stakeholder groups, not just the shareholders. And stakeholder groups, you can see some examples here, but it could be even broader than this. We've got the board of directors. They have their own set of interests, and senior managers as well. The employees have an interest in how the company's governed, and we could add to that creditors, suppliers, customers, government regulators, unions, really anything that's affected by the decisions of the corporate management and the board of directors. One thing to think about in terms of corporate governance is something called the principal-agent relationship, because the agent is hired to act in the interests of the principal. You could think of an insurance agent as an agent to write insurance policies for the company that's a principal. Well, their interests may differ a little bit. Life insurance agent may want to write life insurance for just anybody and get paid. Well, the principal wants to take on only good risks and where the risk is managed. So there's a little bit of a conflict there, and there's various ways to take care of it. In general, the shareholders, who are the principals, the owners of the company, employ the directors and the senior managers to run the company. And there may be conflicts between the agent's interests and the principal's interests. Senior managers may think that a corporate jet is just an absolutely great idea, but as the principals of the company, maybe that's not really the best way to go. And so conflicts can arise between the agent's interests and the principal's interests. Another example is that directors and managers might prefer a lower risk level because they have so much invested in the company, not maybe just in stock, but their jobs, their retirement plans, all these things that affect them. And so they may want to keep the risk lower, but shareholders may have a diversified portfolio where the shares of the company are just one part of their overall portfolio. So they would be, or should say, prefer more risk. In terms of managing these stakeholder relationships, some of the things to consider are the legal infrastructure, the laws that are relevant to stakeholders in these various relationships, the contractual infrastructure, what are the contracts between the companies and its stakeholders, think creditors, suppliers, unions, things like this, the organizational infrastructure, corporate governance process, and just overall how the organization manages these stakeholder relationships and the possible conflicts that arise. The governmental infrastructure refers to the regulations, the governmental regulations under which the company operates. So in terms of stakeholder management, let's look first at the shareholders. The relationship, one of the key parts of it is the annual general meeting, and there can be extraordinary general meetings too when special resolutions that require a shareholder vote come up. In terms of proxy voting, now mostly the shareholders don't all show up at the annual general meeting to vote on issues, so they have proxies. And that just means you assign somebody the right to vote your shares at that meeting. Now, in terms of proxy voting, it can be majority voting, where one vote per share for each board seat. So if there are 8 seats on the board, there's going to be 8 separate elections with 51% in each election, enough to choose that director. Now with cumulative voting, the votes a shareholder has is the shares times the number of seats. And so they can cast all their votes for one board candidate, or they can spread them out across other candidates. The important aspect of cumulative voting is that it gives minority shareholders seats on the board of directors. Think with majority voting with 8 separate elections, an owner or a group of owners of shares that had 51% of the shares could choose all 8 directors. With cumulative voting, that's not the case. Those having 49% of the votes could choose just slightly less than half of all the directors for the company. In terms of the board of directors, we could have a one-tier board. And the one-tier board just means it includes internal directors and external. When we talk about internal, we're talking about employees of the company, typically senior managers, the CEO, for example, chief financial officer, chief operations officer, things like this. And then we have external directors that don't have these employment relationships with the company. And if they have no other relationships with the company, then we call them independent directors. And the thinking is that independent directors are more likely to vote in shareholders' interests because they don't have the same conflicts that internal directors, especially senior managers, have. With a 2-tiered board, there's a supervisory board of external directors and a management board of internal directors. And they can get together, but they also are separated so that management doesn't have undue influence on the decisions of the board. Because remember, one of the jobs of the board is to manage the senior managers. The responsibilities of the board are to set the strategic direction for the company, select and evaluate senior managers, set management compensation, and plan for succession. These are important responsibilities. They also approve large investments, acquisitions, changes in capital structure, and establish and monitor the internal controls that really make up the corporate governance of the company. And the board also needs to ensure the quality of the financial reporting through internal and external auditors. Some of the board committees, boards can have different committees depending on the size of the company and size of the board. They may have different numbers of committees, but some of the important ones we run into very often are certainly the audit committee. The audit committee oversees the financial reporting and the internal controls and internal audit, and they recommend an external auditor to the board. The governance committee implements the company code of ethics, monitors changes in laws and regulations, and ensures the company's compliance. The nominations committee of the board searches for candidates for the board, and they work on aligning board compensation with company goals. The investment committee reviews capital investment projects, acquisition, asset sales, so large-size acquisitions and dispositions of assets. The compensation committee is sometimes called the remuneration committee, and as you might suspect, they recommend compensation levels and types for directors and senior managers, trying to align the interests of senior managers with those of the shareholders. And they oversee employee benefit plans. The risk committee recommends an appropriate risk policy and risk tolerance, and oversee the risk management processes, which we cover in some detail in another volume of our video instruction. So what are some of the factors that affect stakeholder relationships? Well, first we'll look at market factors, and that can be pressure from activist shareholders. We see that more and more all the time, that a hedge fund or other group will acquire a lot of shares and then pressure the board for changes they think will increase company value. The threat of a hostile takeover is also a very real factor that affects management of the company. If the management is not doing a good job in terms of generating earnings from the assets of the company, we see the shares fall in market price, fall in value. Well, a hostile takeover is when another group comes in, buys a number of shares, and takes over the company and says, well, we're going to redeploy these assets, we're going to manage this differently, and we're going to increase earnings. And their object, of course, is to make a lot of money by increasing the value of the overall company. So if the managers aren't doing a job, a hostile takeover or the threat of a hostile takeover can act as an important influence to make them get their act together and deploy and manage the assets of the corporation in a more efficient or more productive manner. There's also non-market factors that affect stakeholder relationships. One is the legal environment, whether they're operating under a civil or a common law system. Communications channel can also affect this. Social media has really increased dissident shareholders' ability to influence public opinion. Before, they'd have to get the name and addresses and send mailings and everything like this. But now with social media, they can bring up their concerns, they can contact other shareholders, and it's just become much easier for them to influence the company in that way. And there's also an industry that's come up of third-party ratings of corporate governance. There's providers now that rate all companies on different dimensions of corporate governance. And this is certainly affecting investors, institutional investors, and what companies they decide to invest in. What are the risks of poor corporate governance? Well, just as you would suspect, if you have weak controls, weak audits, weak board oversight, well, that can lead to a decrease in company value, especially if things have been hidden, swept under the rug, and then they come to light. If there's poor or fraudulent accounting, this can really affect the stock price when things come to light. And lacks oversight of management. If they're selecting suboptimal risk levels, as we suggested they might prefer, if they're doing related party transactions, making loans or buying assets from company managers, and if the compensation is not aligned with the company goals, that can all have a negative effect on company value. And certainly going forward, there are both legal and reputational effects that can impact company value. In terms of analyzing a company's corporate governance policies, one thing to look at is ownership. Are there holdings by affiliated companies or institutions? Are there activist shareholders out there? Are the company's founders because of a dual-class share structure, favoring the interest of one shareholder group over another? We can also look at board composition. Director independence from management is a key issue here. And do they have the expertise suited to the company's strategies? Now, not every board member is going to be familiar with every part, but there may be board members who are really familiar with the accounting and audit functions, others that are good at evaluating risk and implementing risk management systems, and on and on. In terms of management compensation, as we've mentioned, it's very important that management compensation be aligned with company strategy. And one question you'll ask in analyzing corporate governance is, does it have a long-term or a short-term focus? Sometimes management has a little bit of a short-term focus, and it could be the role of the board to make sure that the focus is more for the long-term value of the company over time. And is management compensation stable over time? If management's getting their full bonuses every year, it may be that the performance targets are too easy and it's not acting as a real incentive. In terms of shareholders' rights are weaker with staggered boards. Staggered boards are where the elections are held. Say we've got 9 directors and there are 3 elections. 3 of those seats are up for election each year, so that's what we mean by staggered. Well, this makes it harder for shareholders to make a change. Anti-takeover provisions that protect against hostile takeovers are considered to favor management and not favor shareholders' rights. And those dual share classes where the founders have shares with 10 votes a share and everybody else has 1 vote a share, those are considered weaker in terms of protecting and promoting shareholder rights. Now to ESG investing. This is a fairly new term, environmental and social considerations. So ESG is just this whole idea of considering environmental, social, and governance factors when making investment decisions, sometimes referred to as sustainable investing or responsible investing. So with an ESG focus, this may conflict with fiduciary duty under the Employer Retirement Income Security Act, which is an act that regulates pension fund management in the U.S. As an example of a conflict, say a manager is following ESG principles, especially social or especially environmental, and say, well, we're not going to invest in this industry. Well, that may decrease overall shareholder returns. So the question becomes, is that a violation of fiduciary duty to do it that way? Well, the U.S. Department of Labor recently cleared this up a little bit, and they said it's not a violation for pension fund managers to consider ESG factors when evaluating an individual security's risk and expected return. Those are the 2 characteristics a portfolio manager is going to be concerned with anyway, and they need to evaluate those. So if ESG factors affect those, then that falls right into their normal course of business. And choosing between 2 investments that are otherwise similar in risk and return and say, okay, I've got 2 that are similar, I'm going to pick the one with the better ESG characteristics, with the better corporate governance score, then that's all right too. So I guess we can infer from this that choosing an investment with weaker risk and returns or less preferable risk and return characteristics because it has more favorable ESG characteristics just might be a violation of fiduciary duty. So in using ESG in investment analysis, we've got some terms here. One is negative screening, and this just excludes companies or sectors based on ESG factors. So they may want to exclude mining companies because of their impact on the environment. They may want to exclude tobacco companies. This would be negative screening. Positive screening, on the other hand, refers to the practice of identifying companies with positive practices rated to ESG factors. And these may be something like ESG scores that are produced by these third-party evaluators. And within positive screening, one of these approaches is called the best-in-class approach. And in this, we're going to identify companies within each industry with the best ESG practices. And typically, you can maintain your benchmark sector weightings. So they're not excluding any industries, they're not excluding any sectors. Within each one, they're going, well, let's just choose those companies with the best ESG, corporate governance characteristics, within each of those industries or sectors. The term ESG integration or ESG incorporation, these are broad terms for integrating the characteristics, both quantitative and qualitative, that represent good ESG management. And of course, this could be a little bit subjective. When we talk about impact investing, we're talking about investing to seek profits, but at the same time having a positive impact on a social or environmental goal. When we talk about thematic investing, this is based on a specific ESG factor, perhaps environmental considerations. So there's our overview of ESG investing and introduction to some of the terms that you need to know to understand this and answer some questions about it.